Yes, guys and girls, welcome back to another new fundamental video. So today we're going to look at the three pillars to FX. I actually heard the three pillars term used by Nomura literally not too long ago. And to be fair to you, we have been using exactly the same sort of framework that they use, but we just didn't call it three pillars. We didn't name it at all. So we're going to call it the three pillars today just because it's a great way of actually segmenting it, if you will, into three different parts. So we'll start off with this. You know, this is a great, amazing tool, in fact, to understand is a currency going to drive dependent on which is going to move the currency, i.e. is it going to be this pillar over here or is it going to be this pillar over here? We'll talk about that in just a moment. But I'm sure if I want to show you, you will know exactly what I'm talking about at the moment on this first slide. So there are three considerations when looking at FX markets. So we know rates, we understand yield and interest rates drives where currencies go. We know equity markets as well in terms of risk on, risk off. The whole field of investors, that's definitely a driver of, especially now that we're seeing, that's definitely a driver of markets for sure. And commodities, so commodity prices and its effects on currencies. That's definitely something that we saw last year, you know, during the gas issue in Europe. Gas prices were rising, euro dollar and the euro across the board was collapsing. And that's because it had implications onto that country itself and as a proxy onto the currency as well. So like we said here, there's the stock market, so S&P and the FTSE. Again, doesn't really matter which one you look at. If you want to get the holistic view, the markets will tend to look more at the S&P. But if you want to look at it specific to the currency or the country, of course, if the FTSE is UK or the DAX, for example, is the German, so you'd look at that for the euro, for example. So you can choose whichever, S&P or the FTSE, depending on what currency you're looking at, really. And then sometimes you may lean on rates more than equities or commodities more than rates. It all depends on what's driving that specific currency at that time. Watching how the currency reacts to rates moves or risk on / off news will likely give you a clue on which pillar is driving the currency. This is known as the reaction function. So we're talking about here in terms of how does the currency react determine on which sort of pillar it's leaning on. So is it moving more with what rates are doing? So we know in previous videos, when yields are climbing higher, that tends to mean a stronger currency as well because interest rates are expected to rise as well. However, we know in certain scenarios, rates could move higher, but the currency moves lower and vice versa. But we'll get into that in just a moment. And just looking at how it reacts to the different pillars, which are these three, will determine or tell you which the market's more inclined to be leaning toward. So firstly, let's start with rates. Now, I put it rates, equities, and commodities. That isn't a order you should be looking at it. It's just the order I've just put it on this PowerPoint. So it's not like you look at rates first, you've got to do this, then look at equities. Just look at it all in general and see which one's driving it. There is no right or wrong answer in terms of the way you look at it. Now, comparing bond yields / interest rates is one of the pillars when considering trade ideas. We know this, especially during 2022. That was a huge driver of FX. And to be fair to you, since I'm recording in August 2023, and since the start of this year till now, that's definitely been a big driver. At some stage. Most central banks, as we all know, is towards the end of their tightening cycle now, so it's likely to shift in terms of what channel is going to be driving the currency, i.e. it couldn't be whose bond yields are climbing high, it might be whose bond yields are climbing lower or moving lower the quickest, for example. As we've learned in previous videos, we know the relationship between yields and currency is close, but there is some decoupling every now and again, and that's what I was speaking about earlier, previous slide, about yields might be climbing higher, but the currency is driving lower, and that might be for a specific reason. A common way of comparing yields versus the currency is the 2-year. Don't get this confused with a different asset class. So if you Google like 2-year, it'll come up with a different asset class. In this example here, we're looking at euro dollar versus the German 2-year versus the US 2-year as well. And that's why I just called it 2-year. So don't get confused. With a different, it is known as a different asset class as well, like the 5-year, or the 10-year, 2-year is all different asset classes. So don't get that confused when going out and doing your own research as well. I just called it 2-year just to make life easier. And you can use the rates channel to determine where the currency is in terms of its rate's valuation. Is it under or overvalued? Is it more prone to moves lower if issues creep up? So if we see issues begin to snowball, maybe the rates channel is going to be a big driver of where the currency goes. And then if the FX currency, like what we're going to look at just now, euro dollar is way overvalued in comparison to its rate differential, which is the correct term for what we're looking at today, maybe the euro dollar is going to really pull and get dragged lower by that rate differential, because that may be a driver, for example. So like I said, rate differentials is the correct term, but in this example, we're just going to look at the two-year euro dollar versus the German or the Bund 2-year yield / the US 2-year yield. So as I said, we are recording this in August, and earlier this week we did speak about understanding price targets, but for those who haven't seen it yet, this is what I was showing before. We've actually seen a big repricing lower in its FX valuation, if you will. Before it was up here, we've seen a big repricing lower, and that's because this week we saw a lot of, or especially German manufacturing and services PMIs going even more negative and weak, and that is going to help that rate differential drive in favor of the US dollar. And we have seen a decoupling, if you will. You can kind of see here that it has followed it relatively well, followed it here, and then we saw it decouple where this moved lower, but this drove higher. Although this is moving lower now, it isn't moving at the pace we saw it before, where it was relatively closely linked here. So there is a decoupling whereby rate differentials suggest it should be around 103.671, but the currency is trading at 108.39. And there could be specific reasons for that, which we'll go over today. So that's the euro dollar example. If you want to look at the pound rate differentials versus its currency, you put GBP USD on TradingView, which we'll show you in just a moment, and then GB02Y hyphen US02Y. Remember, you're trading GBP versus the US dollar, so you put the UK's gilts first, or whatever currency you're looking at, versus the other one. You don't put US02Y hyphen GB02Y because it might confuse you. So just put the UK's first if you're looking at GU, or if you're looking at AU, Aussies first, then the dollars, etc. So that's kind of, this is just an example of where the currency should be relative to its rate differential valuation. So if the currency was perfectly tracking yields, which we know the markets do not work like that, but if it was, in sort of previous examples here, we would be trading a lot lower than where we are now. And that could pose some risks for euro if more issues persist up and we see a recoupling with rate differentials and the currency, that would just get dragged very low quite quickly. Let's show how to get price targets through the rates channel on TradingView. So let's look at how to get your price target in regards to rate differentials. This is something to be really considerate of, because a lot of institutions talk about this, and you may be quite confused in regards to how do they know euro dollar should be down here when it's trading up here based on rate differentials. It's actually really simple. I used to think it should take a lot of maths, but I was just back testing it, and I realized that actually it's really easy, surprisingly easy. Now we're going to look at in the screenshot, of course, on the PowerPoint we looked at euro dollar. We'll look at that, how to just get that price target first. We'll go into a bit more detail, and of course we'll look at others as well, like GU, where it should be in regards to its rate differentials, how close is it tracking that, etc. So we'll start with euro dollar. As you can see, we are on the daily time frame for euro US dollar. How you get it up is click this little plus symbol at the top left. I've got it in this example here already because I was, of course, back testing it all. But look at the German 2-year yield, because we know Germany is the largest contributor to the euro area. Markets will be more inclined to look at German bonds in general for the euro area versus the US. So remember, you're trading euro versus US dollar, so you put the euros first, so Germany versus the US dollar. So put hyphen and then US02Y. Click enter. It might look really weird, so unclick it. Then go on to this. You must remember to click new price scale because it puts it on a scale here. Otherwise, if you don't, it looks really out of whack and it just looks weird. So in this example here, you might try and move it down, and you might be like, okay, I need to make sure euro dollar is tracking it like this. It doesn't have to be tracked perfectly, remember. So what you do when you start moving it, it's going to like move the charts around. What you do in this example is just right click it, just reset chart, and that's it. That is the rate where it should be in regards to rate differentials. Now you can see here, if I just horizontal line, although I've got one here, let me just drag this lower. You can see here, in terms of rate differentials, euro dollar should be trading at 103.398. And then just look to your left. So you look to your left and say, okay, this is then the point where it touches the candle. Okay, this is where it should be in regards to rate differentials. So 103, you can round that up if you really wanted to. 103.4 or 104, or just above 103. 103 hold. So that's where it should be in regards to rates differentials. That doesn't mean, like we know here, we've seen some coupling here. We saw it decouple recently here. And there are obviously going to be specific reasons for why Eurodollar isn't tracking yields that much. And that's likely because, remember, rate differentials is a way of reflecting both interest rate expectations and cutting expectations. And the way it has been tracked recently, most of the central banks are near the end of their tightening cycle now. So it's likely not to be tracked by interest rate expectations. It might actually be tracked now by rate cutting expectations. And that is something to note there as well. As we see here, technically, if Eurodollar was trading with the rates channel, it should be down here, but it's not. And we know in FX and in markets in general, it's not always a one-to-one correlation. Sometimes it is where it's like this. Sometimes it's here. Sometimes it was nicely tracked here. But in this example, it's actually decoupled slightly. Because if we know Eurodollar would have technically looked like this if it was tracking the rates channel, but it doesn't, markets doesn't always work like that. Now, that's kind of how you get a price target. If we look back in history, maybe you can kind of see where the rates channel was actually quite, if it lets me do this. Okay, it is. That's a change. Now, reset chart. You can see here the currency was actually moving a lot more in negative territory than its rate differential price target. So in this example here, rate differentials would have suggested it should have been tracking it like this, not as steep and as aggressive. However, we know during sort of August 2021 and so forth, the dollar was actually really rallying, and mainly from June when rate differentials went really in favor of the US and dollar in that example here, based when they moved their dot plot. That was the main reason why dollar basically started rallying sort of towards June 21 and onwards. And of course, data was actually really good in the US as well. But there's always specific reasons as to why maybe Euro isn't tracking the rates differentials as much, for example. But it just depends what pillar you're leaning on. So that's another example there. Let's just look at, let's say, GU. And how is GU tracking its rate differential path? So let me just delete this. And then let me get rid of this because I don't think it will let me go. Now let's go for GBP USD. And then go, remember, click plus button. To make your life a little bit easier to not always click the unclick, you can do the UK's first, rate differentials. So US02Y, enter. So that's the rate differential. Then what you could do is just click the plus button and then GBP USD, and then go to new price targets. So, sorry, I think it's just done a bit of an issue there. US02Y, cool, plus GBP USD. Is it going to let me do it? Yeah. And then you could just click that rather than clicking it and unclicking it. It's up to you. Again, no right or wrong answer. It's just what you prefer to do. Now, reset chart. How close is it following rate differentials? Now, GU is this line, is this blue line, because of course I had candles first. So whatever I choose at the top is going to be the candles. GU would have, if I put GU first and then rate differentials after, it would have, the rate differentials would have been in line. But again, that's no issues, but it's just up to you what you prefer to use. Now, how is GU tracking it? Well, it's actually a lot closer in terms of where Eurodollar should be. So technically, if GU is trading with a rate differential channel, it would be trading at, if you look to your left, remember GU in this example here is on the left here, it should be trading at around 127-ish, give or take. yeah, 126.5, 127 in terms of its rates channel, because we're looking from the line onwards. And we know there's obviously going to be reasons for that. The gilt market in the UK is really high, and we know the markets now are slightly dialing back their bets on the rate path of the Bank of England after the recent miss in PMI data. But we'll go over that sort of in the breakdown tomorrow. However, we know at the moment the markets in terms of the pound, the US dollar is following a bit more of what the rates channel is doing. The equities channel, sorry, is doing. If I just show you that now in just a moment, actually, when we look at equities. But you can see here in terms of rates, it's actually not too far away from where it should be at. So that's not too much of an issue. We know there's a little bit of recoupling here around this period. However, here is a bit more decoupling. It's technically following it quite nicely, as you can see. So just as GU and yield differentials were climbing higher, but it's not exactly closely linked. That doesn't mean you might not lean on the rates pillar. It just means, you know, if you see a huge move in rates in favor of being long GU, you're not expecting too much moves in GU, for example. That's the only thought process you have. So yes, we saw here rates were driving lower. Rates were driving lower. So was GU, but not just at the velocity in which rates were driving lower compared to the currency, and vice versa. It was following it nicely here, just not at the start at the quick enough rate. So you still look at it, but you don't be like, okay, we're seeing a big move in rate differentials in favor. Okay, we know there's a bit of decoupling, so we're not expecting too much movement in the currency, for example. Why is that happening? Maybe it's leaning more in the equities pillar. So that's kind of your thought process. But that's how you get it. Remember, do that. Make sure you have it as a reset chart. And then see, okay, how closely is it following? Because you know, let's say, remember, in terms of rates and interest rates, what we've learned in previous videos is when the markets are more in favor of being long the currency because of interest rates, then if you know the data going forward is going to support more interest rates, you know you're likely more to lean on the equities pillar, or the rates pillar, sorry. We'll go over equities in just a moment. But you'll know you'll be leaning more in the rate differential pillar, or rates pillar in this example. And then from then on, you know, okay, well, data is really strong. We're going to expect rates to go more in favor of GU. Data in the UK, let's say you're being long, is actually holding good relative to the US at the moment. We're seeing risk on in the markets. Equities are driving higher. So you can lean on two pillars at once. You can lean on all three. It depends on, are they tracking it very, very nicely? I.e., is the currency moving higher, and so is rates. And sometimes we saw decoupling where rates were driving higher and the currency moved lower, and vice versa. And that's why it's important to look at what channel is driving it. But in this example, we can look at rates. As you can see here, it's tracking it relatively closely. Not as closely in terms of the currency should technically be something like that, whereby it actually follows it relatively closely. That's what it means by closely linked. But it isn't doing that. We know markets do not work always like that. So that's kind of how you view it. And then you say, okay, if the market begins to, let's say, price in a further, let's say, there's further cuts in the UK than there is in the US. You would expect now the markets to follow that suit, and the gilts will fall a lot quicker than the US naturally, because gilt yields follow what interest rates do, and interest rate cutting expectations do as well. So you know, okay, well, that happens. Currency should technically tank then. Depending on how closely linked it is towards that rates channel, will have a big downside, for example. And then you can position behind that with some sells at some pullbacks, etc. So this is just another way of just reflecting your view through different pillars. So hopefully that's made sense, and we are going to move on to the next pillar. As you just saw, we went over how to get the rate differentials versus the currency's price target, or where the currency should be relative to the price target of rate differentials. Now we're going to look at the next pillar. So of course we looked at rates now. Hopefully that's given you a bit of an idea as to, you might see institutions talk about rate differentials and where the currency should be relative to that. For example, like Nomura spoke about that a couple of weeks ago. So did HSBC last week. So let's see how that pans out throughout this year. But now let's look at the next pillar, which is equities. Equities is a way of reflecting risk sentiment across the financial markets. High equities tend to mean the market is more likely to take on more risk. As a result, if markets are more inclined to take on more risk, then specific currencies might strengthen and specific currencies might weaken. But we know this specific currency will react positively to higher equities, i.e. risk on, for example, like the euro or the Canadian dollar. And lower equities tends to mean the markets are a little worried. And that may be derived from data, it might derive from external factors, for example, like we're seeing now where China is a big issue, European data has really slowed down. So naturally the equity markets, for example, the S&P has fallen, and that is helping to drive the dollar higher and the euro lower. So we know specific currencies are very sensitive to this. But in general, in a risk-off environment, the dollar is seen as the preferred currency to be bought. However, we know similar to the rates channels, equities could be climbing higher, but so can the dollar. So we know here, if equities are driving higher, that's seen as risk on, and we know the dollar is not a risk on currency anyway. So we know there's a decoupling every now and again, and that could be for specific reasons. But look at the price action during Q2 of 2021 to Q1 2022. It depends on that specific time where the markets may be focused on factors that is both positive for the currency and positive for the stock market. So we'll look at that example in just a moment, but we know during 2021, sort of middle of 2021 towards literally throughout 2022, the US economy is really, really good and it was picking up quite quickly. So naturally that means, okay, if the economy is expanding very nicely, that's good for risk. People are great. People are going to get employed, spend money. People are going to, companies will get better profits from that. However, on the other side of the equation, that was also going to be really positive for the currency because we know in that scenario, inflation rises, the economy expands very rapidly. That naturally means higher interest rates, and that is positive for the currency through the rates channel as well. So that's kind of a good way of reflecting. But we know, don't just look at it as a rule of thumb, equities are driving higher, I need to sell the dollar. You have to understand if there's a coupling there or not. And that's, that takes time and that takes patience. But like I said, we've got all those documents for you to read through, so you can always see what other institutions are thinking. At the moment, or at each given moment, there is always something driving a currency. So understanding what is driving it will be a good way of reflecting what channel you'll be more focused on. And that's what I was speaking about earlier about the reaction function. So if data comes out, or if you see rates are driving higher, like US 2-year yield or the gilt 10-year yield, how is that currency reacting to that? So if we see like a big move in rates, but the dollar hardly moves higher, but then we see a big move lower in, let's say, the S&P, and then we see a big move higher in the dollar, for example, that might tell you that the currency might be more leaning towards the equity pillar, or vice versa. Rates might be really falling, but the dollar is just moving higher. Maybe it's following what commodities are doing. So that's the other pillar, of course, which we'll get onto in just a moment. So it all just depends on what pillar it is, and that's what we were speaking about earlier about the reaction function. Just focus and see how the currency is relative to what channel it's trading with. So that's equities. Of course, you can do a lot more research into equities as well. I personally don't need to know everything. I just need to know the absolute basics of what drives equities. I don't need to get into the really nuanced stuff like we do with FX. But as long as we know that the comparison between the rates, the equities and commodities, that's a very, very good framework for you to work with going forward. So this is just a little bit of a comparison between the S&P or GU, GBP USD versus the S&P. And as you can see here, in terms of near term, as markets were becoming more optimistic, they were happy to take on more risk. That was also driving dollar lower. And then for now, we're seeing risk off currents in the market, because of China. That's stemming a lot of risk off. And of course, that's driving the dollar higher and driving risk currencies a lot lower. And that's just a comparison. We saw a real big coupling here, whereby the moves in equities was also a big mover for currency, but we saw a decoupling here. And that could be for specific reasons. You'd have to go out and do your research. What's happening during end of 22, beginning of 23, for example. Or why was equities driving a lot lower, but the currency in terms of risk wasn't doing anything? And you'd have to look at that. But we've seen a bit of a recoupling now, which is always good to see. Let's show how the equities channel is a driver of a currency on live charts. So as we just spoken about, we've looked at equities. And different currencies are, of course, very sensitive to that. We know in that example, the screenshot, GU, because we're looking at pound, which is a risk on currency. Technically, it's risk on currencies tend to mean they are relatively volatile and they export a lot of commodities. However, just because of the UK and its financial system, it's seen as that sort of risk on risk off currency. So in the screenshot example, we looked at the S&P. So remember that, always click new price scale, don't click it. Because like that, it just looks weird sometimes. It's going to be like really skewed, especially when you look at yields, right? So it just looks super weird. What you do is always new price scale. So that's the true representation of where the currency is moving in regards to the rates perspective. Now we saw here, stock markets driving lower in this. Stock markets are to your left here, and then of course currency, as you can see, GU, the target's on the right there. We saw it really closely linked there. That doesn't mean necessarily maybe the UK is following the equities channel. It might actually mean the US is following that rates channel, and that's why you just look at all the comparisons together. But in this example, we saw a bit of, the equities were driving a lot lower. Pounds sold off ever so slightly, not as much as the rates or the equity pillar, sorry. And then we saw a bit of recoupling here. But remember, to get it like perfectly coupled doesn't always happen. In this, in now time, actually, it's actually quite closely linked with each other, where in this example, if equity markets are moving lower, so is the currency, and it's actually following it relatively well. So if there's a big move lower in equities now going forward, you are likely to see a big move lower in GBP USD in this sort of example. You can go back in history, so just go back as well. Make sure you just have sort of the replay tool on. Cool. How closely linked was reset chart? It's actually relatively closely linked here. So bang, 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 slight move away from each other. Just think about the gap. Basically, always think about the gap. How big is that gap? So that's the gap, closes up. Big recoupling here, big couple here, couple here, couple here. And then there was a big divergence here, which is fine. You have to look at the reasoning why. Remember, don't think like a robot. Don't think 1 + 1 = 2. Think, why is it happening? And there's always underlying reasons as to why there may be a decoupling. And this is why you have to do your own research. It takes time, takes effort, but at the end of the day, you're seeing this as a long-term career, so something that needs to be done. So that's an example of GU, again, like the screenshot that we spoke about in that regard. Let's look at now euro dollar. So we'll look at euro USD. So if I just remove drawings versus the S&P. If I reset the chart, in general, euro dollar is an inverse of the XY. So equities at the moment are driving lower because of China. That's obviously dragging euro lower as well and dragging dollar higher. So if you look at the XY, which we'll just get up now, the DXY and the equities. So this is, sometimes it might look like this. In general, if equities are moving higher, that tends to mean dollar lower and vice versa. So just to get it in terms of the pricing, you have to remember you'll invert it. So just click the button on whichever side you have it on. If this is where equities are for you, you have to go down here, but in this example it's here. Click that little cog thing at the bottom and invert the scale. So always remember it's inverted now. So technically, as this driving lower, that's equities driving higher, right? And you can kind of see the comparison, if we invert it, in recent time is not too bad. We're slightly diverging here, which is fine. Equities in this example, this is equities driving lower. This is equities driving higher. We've seen a bit of a decouple here, but overall, it's since basically June, it's actually been following very closely. So if there were issues in China, or if there's big risk on currents coming in, that's going to mean lower dollar. And if there's risk off currents in the market, like we're seeing with China and Europe, that's going to mean higher dollar, because it's actually tracking that equities pillar very closely. And that's when you say, okay, risk on currents in the market means, of course, naturally lower dollar. But nowadays and now times, in the live example, we're seeing a lot of issues in China and Europe. Now, if that drives equities lower, that's going to mean, in terms of the correlation, because it's fairly closely linked, it's going to track it relatively well. And that means from then on is dollar higher, dollar higher, dollar higher, dollar higher, until another pillar takes over. Maybe the rates pillar takes over then at that stage, maybe because the Fed is going to potentially cut and etc. And then as you can see here, it's actually really closely linked to the DXY. So remember, it is inverted. So this is when I was speaking about earlier. So let me just delete that. Just go back in time. Make sure it's reset. Cool, it is. When you start moving it like this, you're gonna have to click reset again. But if you can move it slightly without moving the candles, then that's okay as well. As long as it doesn't move the candles, they need to stay relatively firm. Now, the DXY, of course, has been rallying throughout 2022, but so was equity. So I was speaking about that correlation that we saw with the US and. So let me uninvert that. During sort of 2021, 2022, this is uninverted now, so they are the true to scale. Equities are driving higher, so the stock market, but so is the dollar. Now that's the example where I was speaking about sometimes it's positive for both the currency and the stock market. So this is why it's important not to think like a robot and say this goes on, this must go up, or this goes up, so does this. In terms of the rates, don't think like a robot. Think, okay, this is happening. Why is it happening? That's the important reason. Why is that happening? And then we saw a bit of recoupling here, whereby equities driving lower is meaning dollar higher. And then, of course, in these time here, equities are driving higher, but now the dollar is selling off. So we saw the true couple there. In general, that's the correlation in overall terms against the dollar, is equities higher, dollar lower. But sometimes there's a couple where it happens both at the same time, like in this example. Now, it's not just the dollar, like we've spoken about. It's also the euro, it's also the pound, it's also the Aussie, it's also the CAD. It depends. Remember, have all of the pillars available and think, okay, if this is happening, why is it happening? Which pillar is it leaning on? Get up that chart and see how close is it linking with each other. So is it actually really tracking it very nicely? And in the future, if the overall sentiment is for that asset class to drive higher, as a proxy to that, maybe this currency is going to drive lower, or this currency is going to drive higher, for example. But yeah, that's the equities pillar. Again, you can also look at it from a FTSE 100 or let's say a DAX example. So get up a different, let's say euro dollar. Let's delete this, and this. Then get up the DAX. So just type DAX, enter. How closely is it following the DAX now? So if we invert this, it might be a better, I think I've just messed up. Regular. Actually, if I delete this, DAX, new price scale. There we go. So I didn't click new price scale. That's my bad. This is not inverted. Let me just double check. Cool, it's not. How close is it following this in that regard? Actually, looks like euro dollar's following the equities pillar at the moment. Because we know, yes, technically it's following the rate to differentials pillar that we saw earlier, but the relationship in terms of how close it is, the gap, remember, think about the gap, is a lot more wider than it is compared to the currency itself. Now that could mean, like we spoke about when we speak about the rates, that could mean when there's a reconnection, it was really going to drag the euro lower. But at the moment, we're not seeing that connection. It looks like it's following what the German stock market is doing slightly more, which is fine. And we saw a huge connection here. Whereby euro dollar drove lower to highs, and so did the stock market. And there was a lot of optimism coming into Germany, coming into sort of 2023. Big optimism, and then all the issues with Germany happened basically since May, where you saw this happen, in May. Sideways stock market. A bit of connection there. Sort of decoupled here, which is fine. And then it aggressively tracked what the euro dollar is doing. So this is now, you know, in the future, well, based on what we've looked so far, we'll look at commodities next, of course, but based on what I know so far, the euro dollar is tracking what the DAX is doing, so what the equity market is doing very closely, because we know there's a lot of issues in Germany, so naturally that's going to cause issues for stocks and overall risk sentiment towards that stock market. And it's also going to cause issues for the ECB. So this is a positive correlation. A negative correlation where is in this example here, where it decouples away. Stocks are driving high here, but currency was driving lower. That's a negative correlation. Positive correlation is just it following it exactly based on what's happening at the moment. So there's always a reason as to why something is moving. Most of the time anyway, there's always a reason. But in this example, it's the euro dollar is following basically what the DAX is doing. So we know in the future, if there's more issues in Germany, let's say, you're then going to be following what that DAX is going to be doing. And remember, you don't just cloud everything, base everything on the pillars. You have to consider everything. And trading is not easy, it's hard. So please, this is the equities pillar. I suppose you could, in theory, use that as a, technically, if it's following equities very closely, euro dollar should be trading at 109.785, but we know markets do not always work one-to-one for sure. Don't think like a robot. Always think about the understanding and the why. So that is it on the equities. We'll move on to the commodities pillar now. As you just saw, we looked at the difference between the S&P and specific currencies. Remember, it's another channel to look toward. Rates could be driving higher, but really all in all, they might be the equities that's driving that currency. Just looking at the reaction of let's say a risk on currency to the S&P or the overall stock market, whichever one you want to look at, but mainly the S&P is what I'll be more focused on personally. It will determine, it will tell you which channel is driving that currency. So you look at rates differentials or rates, equities, and then of course we know the next one is commodities. So as we've learned in previous videos, specific currencies are more prone to swings in commodity prices. This is because either they import a lot or they export a lot, thus making their currency decrease or increase in value. So we know that for sure. We'll look at a big driver of that for the euro, as we know. That's a big sort of news flow for the euro, literally not too long ago. And most commonly traded commodity currencies are AED, CAD, and NZD. And that means AED exports a lot of commodities to China, for example, iron ore. So you know, if you want to be seeing if AUD is following the commodity channel, you'd look at iron ore versus AUD. Or for CAD, it's oil. So if you want to look at how, what rate channel or what channel in general, shall I say, the CAD is trading toward, it's oil, so US oil or WTI versus the CAD. And NZD is like dairy products and meat. You can look at the global dairy trade. That is a ticker on TradingView. There isn't too much relationship there though. That is one thing I've noted. So the way we trade the NZD, especially during this time, is just risk on, risk off China mainly. And similar to the other two pillars, there is decoupling, and understanding why it's decoupled is important to minimize both losses and confusion. And this is why you need to go out and research, why is CAD going up, but let's say oil's trading lower? Well, in general, the rule of thumb is when oil trades higher, that's good for that native currency, or the currency that, or the country, shall I say, that exports a lot of that commodity. They should, in theory, be getting better. But there could be another underlying reason as to why that currency is trading weaker, even though their commodity is driving a lot higher. And that, like I said, is to both minimize losses, because you might be saying, actually, I'm leaning on the commodities pillar. So we're seeing oil rally, I need to be buying CAD. But then you're just constantly taking losses, and then you're confused. So this is why you need to go out and research. Maybe it's following the rates channel a bit more. Maybe it's following the equities pillar a bit more, etc. So it's important to go out and do your research as to why this is the case. And then euro dollar. So we know with euro dollar, Europe is very sensitive to gas prices. I've inverted natural gas because if I'll show you in just a moment, if I uninvert it, it's going to be doing that and trading through it. But if we invert it, that will allow you to give you a bit more of a comparison. And so basically, if you're seeing natural gas line here, that's technically it going higher because, of course, as I said, I've inverted it. Euro dollar isn't inverted, so this is the true chart. I went back a bit further, so I went towards 2021 to 2022, middle 2022 as well. You can kind of see there was a good comparison where natural gas was driving higher, but euro dollar was also driving lower. So that's a good relationship between them both. Bit of decoupling here. So naturally, as I said, this is inverted. So this would have been a big sell-off in natural gas. Euro dollar consolidated slightly, and then we sort of recouple very quickly here, where the natural gas prices really recoupled with what the current currency valuation was in relative terms. So you can go out and do this research. So go on to like oil and look at the relationship between that and the Canadian dollar, similar to Aussie. Go out and see how iron ore prices are tracking the AUD and which channels. So you need to go out and do a lot of research. Remember, it takes time and it takes a lot of effort. But let me just go back to this one here, which is really important. And if they import a lot more, so we know the relationship, what we just looked at earlier with regards to this one over here, which is euro. Technically, euro doesn't export a lot of gas, right? However, they import a lot. So they're very sensitive to prices and changes in prices. So it's not necessarily looking at commodity currencies, it's looking at the relationship between that specific commodity you're looking at and how and what currency is very sensitive to that, for example. So a lot of importing countries, for example, like the UK, Europe, they are going to be very sensitive to higher commodity prices. And looking at that relationship is really key to see, okay, UK is, let's say, in a really bad rut. Well, higher commodity prices isn't going to help it, is it? But it's just going to make the issues worse. And that's why it's really important to go out and do more research, not just looking at as a rule of thumb saying this does this does this. Don't think like a robot, basically. You have to go out and do a lot more. But for now, let's look at how commodity prices or the commodities channel is a driver of currency on live charts. So, commodities. So as you learn with commodities, in particular, what we're speaking about the real consideration is it's not always commodities higher, this currency has to drive higher, because it depends on what is actually driving the currency. And that's what when we go back to what we spoke about earlier in the PowerPoint about understanding the reaction function, looking at the spread between the US 2-year and the Canadian 2-year, for example, for USD CAD rate differentials, or looking at how closely is the pounds following the FTSE, how closely is that relationship going on, etc. Now we're going to look at commodities, of course, which is completely fine. Understanding what commodities doing is really important to know going forth. Now, in the screenshot example, we looked at euro dollar versus natural gas. And we are going to look at other examples as well. And we know euro technically doesn't export natural gas massively. It might do it as some slights, that's fine, but it's not its main commodity, if you will. So it's not really going to be gas higher, so is the currency. It's actually more as the function as Europe imports a ton of gas. So if we know gas prices rise, that's going to cause issues for Europe. Now, in some examples, that there is no couple there, so it's not linked with each other. Maybe the Germany and Europe, Euro area in general, economy is really good, so a little tick up higher in natural gas prices shouldn't really cause too much of an issue. But now, in terms of where we are to current time in August 23, Germany's facing real big struggle, and so is the Euro area on the whole. So naturally, if there's a tick up in natural gas prices, that's going to cause more issues for their economy, and as a result, going to cause more issues for the currency and Lagarde and the ECB. So that's kind of how it all tells in together. Similar to the UK, maybe there's a big tick up in oil prices, or for Japan's a huge importer of oil. If oil prices tick higher, that's going to cause a lot of issues for Japan. So it's not just necessarily CAD exporting oil. That's the only relationships you look at. It's about each commodity prices you look at and which currencies are affected positively and which currencies are affected negatively. And that's how you think about all of that in general. Now, we'll look at AUD in this example as a more near-term example. AUD USD, we'll stick to that. We're going to look at iron ore. So the ticker for that on here is FEF1. Come down. And then this one here, you want iron ore. Now, how closely is AUD USD following this? Let's just zoom out just to get an overall comparison. You can kind of see the relationship's there, right? We're not talking about in terms of how closely links it into relative terms, but we're just looking at it in the broad picture. It follows it very nicely. Whenever there's a big pullback, it tends to follow it very nicely. There. This didn't really drive the currency too much though when iron ore prices were really aggressively bounding higher. Again, that could be for specific reasons. Similar to here, huge slump in iron ore prices, but the sort of velocity and the move in the currency didn't reflect that. Naturally, you're not going to expect sort of AU to collapse to sort of 63 in 105 days. Again, that can happen, but it may be a bit unlikely. But nonetheless, in this example, if we just reset the chart, remember, always reset it to get the true comparison here. We've seen a slight divergence recently. Because it's a commodity, it's also affected by supply and demand metrics. So if there's an issue with supply, naturally, similar to oil, you know, if there's an issue with supplying oil, let's say, I don't know, a really bad weather in Southern America, or Southern USA, that's going to affect a lot of the oil plants, sort of in Texas and all of those southern regions. That is going to affect the current prices of oil as well. And that's going to spike high. It doesn't necessarily mean fundamentally it's really strong or it's got really good demand and supply metrics. It just means there's an issue. Or let's say there's a little bit of a war in Iraq, or a war in, let's say, the Middle Eastern countries that export a lot of oil. Naturally, that's going to cause oil prices to be really volatile. Even as simple as a ship actually getting stuck in the Suez Canal, which is a real busy transport link across the globe, right? Going from east to west. That is going to cause issues because naturally their biggest sort of region that has a lot of oil tankers is going to get disrupted. So it's important to understand, is this a supply and demand driven metric, or is this a true fundamental reasoning? Now in this example here, there was actually a relatively closely linked example where technically it did diverge slightly in terms of the gap got really wide here. But then it really recoupled aggressively here and then followed it very nicely. So you know, in this example here, let's say we were trading during this period. Even in this example, very nicely closely linked. Slight decoupling there, fine. That's, you know, there could be a fundamental reason why that could have happened. But you know, if you're trading through this period here and this period here, if you have a bullish view on, let's say, iron ore, you are going to expect AUD USD to be bullish in this example here. And if you have a bearish view on iron ore, let's say during this period here, you saw China issues. So naturally markets, or China's not going to buy as much iron ore. That's going to affect the prices of iron ore as well. And we know in general, when prices fall, that's going to drag that currency that is really prone to sensitive to that commodity because they export so much to it, is going to struggle as well. And then you might have a more bearish inclination in terms of the commodities channel, because that could have been the main driver of commodities at this time here. Even if you weren't looking at it from this example, maybe you were looking at it from here, well, it actually closely linked, it did closely follow it. A bit of decoupling here, okay, that's fine. I.e., yes, technically iron ore prices did fall, so did AU, but the velocity and how close that gap is the one you want to be a little more focused on. And you know here, okay, bang, bit decoupling here, but now we saw it recouple quite frequently here. So now you know, okay, if iron ore prices fall, that's why you look at fundamentals for commodities, fundamentals for equities, fundamentals for FX, and then it all drives and works within each other. You now know in the future, if iron ore prices fall, that's going to drag AUD USD lower because the relationship between them both is actually really close. If you want, you can just pull this to a line chart and see it on a line chart perspective. People work differently, of course. But if you don't want to, you can, of course, just leave both candles or have both lines as candles, both lines as a different one. It's completely up to you. It depends what you prefer to do. But then we know now if iron ore prices fall because fundamentals are driving, let's say, iron ore prices lower, you might have more of a bearish tilt, if you will, on that currency. Now, you don't just use that pillar in terms of a commodity pillar as the reason to get short currency. You may have to look at other fundamentals as well, but if they all do support each other, then that's good. And that's going to be a great way of reflecting a bearish view on a currency. And again, this is just like another confluence, if you will. Remember, trading is all about getting confluences and increasing your probability, basically. Because you never know 100% what's going to happen. Fundamentals and all of these pillars is all about increasing your probability. Now, in terms of a live example, where there's a huge gap and a huge decouple, naturally, if iron ore prices really spike, we're not expecting too much of a rally in the currency in this example here. And that's fine. You know, there are going to be reasons for that. China is the main one in this example. Now, let's look at US dollar versus Canadian dollar. So CAD versus oil. So this was on the breakdowns. We just delete that. So obviously rates, commodities, and stocks. Okay, cool. So we're in iron ore still, so just delete this. You can just click it and press backspace. And this, now we know we're in USD CAD, so we want to look at oil. So remember, oil. So in this, we look at US oil. Always, if it's going to let me. See, sometimes it works, sometimes it doesn't. But in this example, what you could do, if it does something like this, is just play around with it and say, okay, if I do this, it's going to let me. Okay, new price scale. Okay, that's fine. Because if you don't click new price scale, if I just briefly show you that, you just click that, look how weird it looks now. And then it's gonna look, that's what I mean by you have to click new price scale. Because it just puts it on the same scale, just on the, their ticker on the left. Or the right, depends on which one you prefer. But new price scale always. Okay, cool. How closely linked is oil and what the Canadian dollar is doing? Well, technically you're looking at US versus Canadian dollar. If you want to look at the relationship, you have to look at CAD versus the US dollar. So what you could do is just invert it, and then that's the CAD versus the US dollar. So you can kind of see that the relationship as of sort of this period is really close. Then we got to this period where it really closely linked to each other. Bit of decoupling there, that's okay. Bang bang, iron ore technically, oil prices technically should have said CAD should have fell to this. Because remember, we're looking at CAD versus the US dollar now. We're not looking at USD CAD because we've inverted the chart. And then it recoupled really aggressively here. Technically, CAD should have been trading down there if it was following the equities pillar. You know, markets don't always work like that. Now it's relatively following it now. Now, if you know China has further issues and commodity prices are falling, that's going to drag CAD lower. So that might actually mean USD CAD pumps a little bit higher than where we are now. Especially you have a near-term bullish outlook on the dollar, that makes sense from both a fundamental perspective in terms of risk on, risk off, the commodity pillar, and what's happening with the US and its economy and the resilient data that we're seeing in the US. So that's something, you know, that's how you combine all three, if you will, in terms of the pillars and work with that. In terms of rates, you can always look at the rates pillar as well. The only issue I've sometimes found is putting rates and equities and commodities all on the same chart is just becomes a bit too clouded, or it doesn't really put it onto the chart properly. Let's test it out here. So we can look at USD CAD. So untick it, bang, and then new price scale. Because what I've noticed is sometimes it will drag it to try and fit all of it in, and it's not going to give you a true representation. So that's why you want to tend to sometimes just look at it all on one at a time. So look at USD CAD versus oil, and then USD CAD versus equities, USD CAD versus rate differentials. So if we just delete this now, you can kind of see how it moves up. Reset button isn't on there, so that's the true representation. But technically this is US versus CAD, so what we do is we have to invert the yields on this one example here. So you could, let me just invert this. So that's the representation in terms of yield differentials. And as you can see, a bit of decoupling there. It's following more with what commodity prices are doing in regards to CAD in general. So that's kind of how you have to, you do have to play around with it. You see there's a relatively close couple, especially here, bang. When Canadian yields are falling a lot quicker than US is, we can remember we've inverted these scales, so technically the CAD, Canadian 2 years versus US 2 years, and CAD versus US dollar. But you saw here, bang, CAD yields falling a lot quicker than US is. That's driving CAD US dollar even lower. And that's something to really be considerate of for sure. And now we know there's a bit of decoupling there, but we know at this given stage anyway, so this we have to play around with it and think, okay, what's the representation here? Stock market is in its true representation. It isn't inverted. So we know CAD is a risk on currency in general, and the markets are a bit more risk happy. They tend to be long CAD, as you saw here. Stock market sold off, so did Canadian dollar. Strong equities did try to pull CAD slightly higher, not as much, but it did pull it up. And then a big decouple here in terms of the gap. So now the markets clearly aren't following the rates channel. So this is how you get it all in one, work with each other. So we've looked at the rates, not really following rates too much. Looked at equities, not really following equities too much in terms of how closely linked the moves are relative to what it is. If we look at oil, it's relatively following oil. So now you know if oil falls a bit further, CAD should technically weaken further, which means USD CAD pumps a little bit higher as a result of that. And of course, higher dollar equals lower commodities in general, just because they're priced in US dollars. Now, hopefully that's made a lot more sense in how you just work with that framework. Of course, the last bit we were working out, okay, which one is the pillar following what we have to go for rates? How closely is that? One, look at, is it following it? So the yield in this example here could have been something like this. Is it following it? So firstly, don't think about the gap. Think about, okay, is it following it? At the moment, in this example here, in terms of oil, it is following it. In terms of basically, for instance, here onwards, it has been following it. So lower oil prices means weaker CAD. Remember, this is inverted. This example here, technically, it was following ever so slightly here. But the gap between them both was so big that the sort of, think about it like the strength, if you will, of that relationship isn't as strong. And then in this terms here, the strength of the relationship is only a little bit. So technically, if you have a bearish view on oil, maybe because of China, or maybe because of a stronger dollar, you know CAD US dollar or USD CAD is following basically what oil prices are doing. And CAD is following that very closely. Then you can look at equities and everything in general. So hopefully that has made a bit more sense. A bit of a chunky video, I know, and you may have to do a lot more research. However, I've given you a very good framework to work with going future. And now what you need to do is go onto the charts and get up all of these comparisons and see which currency is following more each other. Because now you know if equities are driving higher, you might need to do a bit of research into the equities. And then you know, okay, based on my research, I'm seeing equities go, let's say, further higher or further lower. This is going to mean this for this currency cross that we has a very close relationship with, based on the gap between the yield or the gap between where the current oil prices is and where the CAD valuation is. And that's how you work with that. So hopefully that's made a lot more sense. Again, if you have any questions, please at me in the Discord. But now what you have to do, like I said, is just go onto the charts and get out all of these comparisons for all the currencies you trade. So have a good one, everyone, and I will see you in the next video. Take care.